When you hear the name Republic Services, you probably just think of a garbage truck, right? But their latest earnings report, well, it shows something way more interesting. It's a story of a company that's not just dealing with today's economy, but is also building a high-tech, green energy business for tomorrow. So let's get into it.
So right off the bat, here's the big puzzle from their fourth quarter report. They actually made more profit than all the analysts expected, but they brought in less money overall. How on earth does that happen? Well, that's exactly what we're going to unpack. It's really a tale of two sides. On one hand, you got some amazing financial discipline, and on the other, some pretty tough market headwinds.
All right, we're going to break this all down into 5 quick parts. First, we'll hit the main numbers, the scorecard. Then we'll look at what's really driving their profits. After that, we'll see what's holding their revenue back. Then we get to the fun stuff, their big bets on the future. And finally, we'll see what they're telling us to expect for the year ahead. Okay, first up, the scoreboard. These are the big headline numbers that Wall Street obsesses over. And honestly, they tell a story of a real split decision. So on the profit side of things, everything looks fantastic. Republic Services delivered earnings of $1.76 per share. That's the bottom line number investors really care about, because it tells you exactly how much profit the company made for every single one of its shares out there.
But then you look at the top line, the total cash coming in the door, and it was $4.14 billion. Now, that is a massive number, for sure, but it actually fell short of what everyone was hoping for, as you're about to see.
And boom! This slide basically tells the entire story in a nutshell. You can see they crushed their earnings expectations by a solid 14 cents per share. That's the great news. But look over on the revenue side. They missed the target by over $76 million. So here's the takeaway. They are getting more profitable even while their sales are facing some pressure. So how'd they do it? Let's find out.
So, yeah, how did they manage to pull that off? Let's pop the hood and go inside the engine room to see what is powering all this profitability.
All right, we need to get on the same page with a key term here, adjusted EBITDA. The easiest way to think about it is as a pure measure of a company's horsepower. It's their core profitability before you factor in all the complicated accounting stuff. It's just a really good way to see how the actual business is doing day to day.
Now, check out this trend. The company's EBITDA margin, that core profitability we just talked about, it actually grew for the full year. What this means is for every single dollar of revenue they bring in, they're keeping more of it as profit. They're just getting more and more efficient, squeezing more value out of everything they do.
And all that efficiency? Well, it translates into cold, hard cash. They generated $2.43 billion in what's called adjusted free cash flow for the year. This is the pile of money they have left over after paying all the bills and investing in their equipment. It's the cash they can use to buy other companies, pay out dividends, or pour into new tech. It's a huge sign of just how financially strong they are.
So what's the secret sauce here? Well, it's not just one thing. It's a few really smart moves. First, pricing. They were disciplined about it, raising prices by an average of 4.5% in the fourth quarter. Second, their customers stick around. They have an incredible 94% retention rate. And third, they're just keeping a really tight lid on their costs. That right there is the playbook for growing profits.
But it's not all sunshine and roses. That revenue miss we talked about earlier, it didn't just happen out of nowhere. Let's flip the coin over and look at the real-world pressures this company is actually up against.
This table lays it all out pretty clearly. First, organic volume, that's the actual amount of stuff they collect, was down 1%. And that's mainly because the construction and manufacturing industries have been a little weak. Second, the price they get for recycled materials like cardboard and plastic, it dropped a lot, from $153 a ton last year to just $112 this year. Ouch. And finally, their environmental solutions group had a tough go of it, with revenue falling $60 million, mostly because a huge one-time emergency cleanup job from 2024 didn't happen again this year.
So, with those kinds of headwinds blowing, how does a company like Republic Services plan to keep growing? Well, this is where we get to their forward-looking strategy, and it's a massive bet on technology and sustainability. See, the company isn't just sitting back and waiting for the economy to get better. Nope, they are actively reshaping their entire business, pouring tons of money into things designed to make them smarter, faster, and a whole lot greener.
And hey, you don't have to take my word for it. The CEO himself, John Vander Ark, said their investments in digital tools and AI are expected to unlock, get this, 9-figure efficiencies. We're talking hundreds of millions of dollars in savings from things like AI-powered truck routes and super advanced pricing tools.
Their green strategy is really cool. It's basically a 3-pronged attack. First, they're building these advanced polymer centers that literally turn plastic trash into valuable new materials. Next, they're capturing methane gas from their own landfills, which is a really potent greenhouse gas, and turning it into clean energy. And finally, they're going electric, adding another 150 EV trucks to their fleet just this year.
And their growth plan isn't just about what they're building in-house. They are also on a major shopping spree. They're planning to spend a mind-blowing $1 billion on buying other companies in 2026. And they're already almost halfway to that goal.
So, what does this all add up to for the year ahead? Let's look at the company's official forecast, which kind of pulls everything together, the profits, the headwinds, and all those big investments into one single picture.
And really, this chart says it all. Even with all the challenges, they expect their cash machine to just keep getting bigger and bigger. They're forecasting their adjusted free cash flow to grow to about $2.54 billion. That's steady, continued growth in their financial firepower.
Now here's where it gets really interesting, kind of the hidden story. The official growth numbers, they look okay. But the CEO pointed out that if you pull out those big one-off disaster cleanup jobs from last year, the underlying business growth is actually much stronger. We're talking closer to 4% for revenue and over 5% for profits. It just shows the core business is healthier than the headline numbers might make you think.
Which leaves us with one last, kind of provocative thought. When you look at their massive investments in AI, in data analytics, in polymer science, and renewable energy, are we still just looking at a trash company? Or are we watching an old-school industrial giant quietly turn itself into a tech company, just one that happens to wear a different uniform? That's the real question to think about.